everyone, this is David Locker from bngloans.com, and today I've put together a quick training about asset-based loans in which we're going to discuss the current market for asset-based loans. We're going to talk about some of the things that you need to look out for, and we're going to discuss creating the ideal scenario for funding your business needs. Now first, a quick summary on asset-based loans. These loans require some form of collateral, and more commonly it's for accounts receivable or the inventory of a company. But other assets such as business equipment or commercial real estate can also be used. But you're going to find that you're going to get the most funding from accounts receivable, which is going to be around 75 to 80% of the invoices that are owed to you. Now, you can also get a loan for inventory, which is going to be around 50% of the potential profit for inventory. And then for your equipment and commercial real estate, that's going to fall in between a 50 to 80% of the amount that qualifies as an asset, which means the amount that you don't owe anything on. Now, as far as terms, some lenders are going to offer lower interest rates due to the loan being secured by collateral, but that's not always the case. And when I say interest rates, it's not always interest rates that are assessed as fees here against asset-based loans. Sometimes it's a percentage, but we're going to talk about that more in depth here in a second. So as far as the percentage rates or interest rates and fees, these finance companies are not considering creditworthiness or your bank rating or your cash flow as approval criteria. So it makes the loan more of a risk on their part for giving you more lenient criteria. So they can often charge those higher interest rates and fees and get away with it. Now, additionally, lenders are going to tend to charge the same due diligence fees and monitoring fees for businesses for small businesses as they do for large businesses, because their monitoring cost isn't going to be much different based on the size of the loan, and their due diligence cost isn't going to be much different. They're still going to be, investigating this pretty deeply. So they generally prefer to do so for medium and large-sized businesses for these types of loans, because those medium to large-sized businesses are 10 million plus in annual revenue. Now, other cautions that you need to have in place is business owners, they're not always going to like the financing company invoice collection criteria. And oftentimes the lender is going to require that these invoice payments are made directly to them or to a third-party service, and they're going to annotate that in the loan terms. And that's going to present a couple of different issues. For smaller businesses, it could be the possible alienation of a loyal client base for that particular company, because now those clients are making payments to some third-party service or financing company, and they're not making payment to where the product or the service originated. And then there's also the more important factor, which is the business is going to lose control over its cash flow, because now, again, the payments are being made to that third-party service or that financing company. So you have to make sure that the loan amount is going to cover you for the full term of the loan as far as your cash flow needs. Now, as far as considerations from setting certain parameters to know when an asset-based loan is right for your company, some lenders are going to actually require a portion of the profits as opposed to charging interest on the loan. And this creates a different dynamic of calculating whether that loan is going to be profitable. Usually we use the 30% of half a potential profit, because we tell you to determine how much you need for the loan and then determine the potential profit from a realistic standpoint. And then we want you to be conservative by cutting that estimated potential profit in half, and that's allowing for variable change. And then you take 30% of that potential profit, or half the potential profit, and if the loan cost in fees and interest or fees and percentage is going to be more than 30% of half the potential profit, then you need to consider other forms of funding, because we feel you can do much better, especially if you're following the steps for creating the ideal scenario for funding your business that we lay out in the next slides. So make sure that you have complete transparency. All right, so next we want to discuss the ideal scenario. We receive a lot of questions about whether a specific loan or line of credit is the right financing decision for a business, and whether there would be other alternatives that would have better terms. Now, the answer to that question is difficult to predict given the variables on both the businesses and the lender's side. So we would like to propose a better question, which is what we feel business owners should be asking. And that's, how do I find the best loans or lines of credit with the best terms for my exact financial situation? Now, I know this may seem obvious, but if you've spent any time researching up to this point, then you know how vague financing companies can be when they're trying to get you to apply for a loan. And the reason is they don't want to deter you from applying. Lenders and financial advisors have quotas to meet, and the criteria is sometimes a little bit more lenient than, say other times of the month. So if they put hard criteria down on their application or their website, then they could lose the chance of you applying in the first place. And that leads to businesses applying to loans that they're not qualified for or wouldn't be a good option for their business, and then they're denied without much explanation as to why. So the solution to the problem is knowing your business's fundability from the start, and then understanding how it coincides with the specific lending criteria prior to applying for any loans or lines of credit. Now, this allows you to make the necessary adjustments to ensure that you're approved prior to ever applying. So we strongly recommend that you acquire your business fundability score. And you can do that by taking a short test that's available through our website at bngloans.com. And this is a no-cost test, and it's a lot like looking at the exam the day before you have to take it, so you know exactly what you need to study. Now, this isn't like a test in the true sense of the word or something that you have to study for, but we call it a test because it's a rating or a scoring of your business, if you will. And the study part comes when you're fixing any of the problems prior to needing to pass the lender's test when you actually apply for a loan or line of credit. Now, what the test does is it provides invaluable insight into your business's financial foundation. And it's going to allow you to see exactly what loans or lines of credit that you're pre-qualified for right now. And it does this all without creating an inquiry on your credit report. So if you were to go off and apply to a bunch of loans and lines of credit, that creates an inquiry on your credit report. And if you consistently do that, then it's a negative impact. So the unique advantage here is that you're going to see your business from a lender's perspective. And you're going to know if there's anything that should be corrected prior to ever applying for a loan or line of credit. Now, this creates the potential for that ideal scenario of having multiple funding options available to you where you can pick the best terms for your business's circumstance. And it's going to help you determine exactly how to achieve that scenario. But it all starts with the business fundability test, which you can access the test below the video. It's only going to take you about 10 minutes of your time, and it provides an extremely valuable resource for you getting the funding that you need. Now, we know your time is valuable, so we promise not to waste it. I want to thank you for watching this video, and I truly hope it has given you a great insight on your next steps to getting business funding. This is David Locker for BNG Loans, and we will see you on the inside.